Welcome to the Daily Brief, where we'll go over the action in the market for Tuesday, December 20th, and then see how things look for Wednesday, December 21st. We had a little bit of an up day. What we have to look at is, do we see things shifting back more positive, or is this just a slowdown in the bigger picture of a negative decline? Right now, it looks like we're just slowing down before we could get ready to go lower. Everything is pretty negative right now. We didn't see much of an improvement in our charts on Tuesday, so we kind of have to take that stance until we see enough evidence to suggest otherwise, that we might see more than just a bounce and actually turning back much more positive. So what happened in Tuesday's session? Right at the open, we had a lower open, and then we didn't get all the way down to S1 at 37.94. We ended up stopping above S1. Prices then rebounded above the daily pivot at 38.24 and never got up to R1 at 38.48. So we had it was more of a sideways day. Prices just ended up chopping. We didn't see a lot of conviction on either side. And some of that's probably due to the short-term oversold condition of the market, where we had gone down pretty far, pretty fast. And so we saw some exhaustion to the downside. The unfortunate thing is, if you're bullish on the market, we haven't really worked off a lot of that oversold condition. All right. So as the day went on, prices spent the day chopping above and below the unchanged level and the daily pivot. We were up 0.10%, so just barely up. We were up a little bit more than that, but we gave some of that back going into the close. Volume was below average and declining, and we've kind of switched over into holiday mode as far as the stock market is concerned. And it would not necessarily be surprising to see most days be below average, unless something big happens. You have a lot of folks that are trying to get away, and it was a frustrating year, and maybe they just want to be done with the stock market for 2022 and go home and enjoy the holidays with their family and friends. The fixation or the technicals are still negative overall. We haven't really switched over positive, even with the slight bounce in Tuesday's session. The inflation scenario and interest rates, that's what's driving the market right now. We're seeing a real panic or real fear that's starting to get over into the concerns about the earnings per share and the valuation of the stock market as a whole. Here is the daily session where we had a little bit lower open. We came back, went slightly positive, went above the daily pivot, never got up to R1 before falling back and then going negative. Then we pretty much danced along the unchanged level, went a little bit above the daily pivot level, back down to the unchanged pivot level area, and then closed just slightly above the unchanged level and slightly below the pivot. So what are some comments? So far, 3,800 has held. That was the line in the sand. If you look back here on our chart, which I'm trying to go back to here, the low was at 37.95. We just went slightly below 3,800. That didn't last for very long, and that ended up being the low of the day. But so far, that is positive. It's more of a psychological level. It's not really that big of a technical level. So that has held. The big news that happened in Tuesday's session was there was a surprise bond yield shift that came out of Japan. The Bank of Japan said that they will allow their 10-year bond, that's the Japanese government bond, to move plus or minus 50 basis points from zero, where before they had said you could only go above or below the zero level by 25 basis points. Now they've raised that to 50 basis points because they're starting to see some pickup in inflation in Japan. And this is in an effort to improve market functioning. Well, that's nice and ambiguous there. And then also the Bank of Japan maintained its benchmark rate at minus 0.1%. They still have negative interest rates in Japan, and their bonds have really been going sideways. It hasn't participated in the upward movement in interest rates that we've seen in the US, in Germany, and in the UK, and in other significant markets around the world. When this came out, the Nikkei fell. That's the Japanese version of the Dow or the S&P. It fell 2.5%, and world bond prices also declined. That fed over into the US, where bond prices were down and interest rates were up. There's still this concern about spreading COVID cases in China, and that may have an impact on the supply chain as well as those companies that do business in China. There's still this concern about the earnings per share as well as valuation with US stocks. The US dollar did decline, which sometimes gives some support to stocks, but interest rates were up, and that sometimes provides a headwind. So that's why we saw things more indecisive as far as the stock market was concerned. On a short-term basis, we still have not worked off this oversold or extreme negative condition with our moving average study going back 20 periods, with our rate of change 5 periods, the McClellan oscillator, the PMO studies, our stochastics, our Stoch RSI, and the Williams percent R. And I have some of the charts here to show you where even with the up day, these charts are still pegged pretty extreme negative. Intermediate term, nothing really has changed there. We still have the CCI 14 period and 20 period that are extreme, but other than that, we're not oversold in the intermediate term. We still have our yield curves that are inverted, that have been inverted for quite some time. Sentiment is still negative, where we're ticking more down into the fear side. And I have another chart to show you that measures sentiment. The economic reports that came out, we really are seeing a slowdown in the housing market, which is not really surprising. We've seen that trend over the past few months. Well, in Tuesday's session, housing starts came in down 0.5% on a month-over-month basis, and this seasonally adjusted annual rate, that's SAAR, at 1.427 million units. That was more than the expected 1.395. Single unit starts were down 4.1% to 828,000. Building permits, which another indicator that we can use to look ahead. It sometimes is a leading indicator for us. Building permits were down 11.2% on a month-over-month basis, and on a seasonally adjusted annual rate, they came in at 1.342 million. This was less than the expected 1.48 million. And permits for single unit dwellings, always love that word, dwellings, were down 7.1%. So we're seeing continued weakness in the housing market. Our trend is still negative. Even with the up day, the ADX is still below the moving average. It is weakening. And because we're below 20, we're in that trendless environment. Our bias, I'm still keeping it negative, because even though we were up 0.1%, it's not really that much to brag about. And I'm keeping our momentum at negative. So here is the chart that we've been following, updated as of last Thursday, where the green is what the S&P did back from 2006 through 2008. And so far, we've been kind of mirroring what's happening. Well, if we continue to follow this example, we're seeing some weakness going forward here. And even with some weakness that we've seen in the S&P, it could get a lot more intense than what we've seen so far. The VIX really hasn't changed all that much. It's still pretty low. It's into the 20s, the mid kind of low 20s right now. But if we really start to fall, so far as we've been dealing with this decline, the VIX hasn't really been rising. Well, if it does start to fall, we could see the VIX really spike up and eventually get to an extreme reading where oftentimes that will mark a low. But we're not seeing anything like that right now. Here's the other indicator. It's called the Ulcer Index, which attempts to measure sentiment. When we're above the moving average and increasing or getting higher with this chart, that just means that fear is increasing. When we're below the moving average and declining, that means that fear is decreasing. And as we've been going down here, the Ulcer Index has been starting to go up. Here's the rate of change going back 5 periods, showing that we have not worked that off yet. This, after Monday's session, it was extreme negative, and it continues to be extreme negative. Here's the equity put call ratio, where it did go up a little bit with the up day. And then overall, we're still continuing to advance. When we look at our 5-period simple moving average, or the equity put call ratio, this is pretty high. We had been working off of this spike here. That really didn't produce anything in the market. So now the equity put call ratio is going back up, at least over a 5-day period. And at some point, if we spike, that sometimes will mark a top in the S&P 500, but it hasn't done that so far yet. Here's our trend showing that we're still below the moving average, even though we're turning up just a little bit. We're still below that moving average. The red line is on top, even though it declined. It's far away from the green line, which is on bottom. So we're in a trendless environment where we're defaulting to the negative. Here's the Arun, which I showed in yesterday's video. It's continuing to decline, showing that selling pressure is in control right now, with buying pressure or buying power really decreasing. When you compare the two, it just shows that we're below zero and still declining. So that continues to be more negative. The BPI, even with the slight update, it's still declining after spiking here throughout November and into December. We're starting to come down. And a lot of times when we spike and then fall, that marked a top in the S&P 500. Here's another study. These are our PMO studies with those that are rising. Even though it turned up, we're still extreme negative. We're extreme negative with the buy signals, and we're declining with those PMOs that are above zero. Stochastics, again, these are subdivisions of the short-term time frame, where the really, really short term is still extreme negative, intermediate term is extreme negative, and we're still declining with the long-term view of the short-term time frame. How's that for confusing? Looking at our moving average study, even though we turned up, we're still extreme with the 20 period. We turned up slightly with the 50, and we're still declining with the 200. Here's the McClellan oscillator. Turned up slightly, but we're still below this extreme negative reading right now. In our double and triple exponential moving averages, we're below this anchored moving average going back to the COVID low. So that is negative. And here's our daily chart showing that we dropped a little bit down below S1, but we were able to close right back at S1. And then down below, we can see where volume is below average and declining. So not a lot of improvement was really made in Tuesday's session. Here's our moving average tree showing that we're still below all of the moving averages right now, with the 50-period simple moving average. That was the last area of hope as far as these moving averages are concerned. New highs, new lows saw a continued advance of the new lows, even though it slowed down slightly. We're declining on the 5-period, and we're flat to declining on the 10-period. Swindling trading oscillator continuing to decline based on price and volume, and starting to get almost extreme based on volume. Point and figure drew in a new zero on here, and we're still working off of this double bottom breakdown. So this is turning more negative. However, with this blue line that's coming up, you draw that under an advancing trend, or a trend that's going up. So we want to see, can the point and figure chart not break below this blue line and cause this to redraw? On a Fibonacci basis, we're still above this double fib level on our short-term fib chart. Where can we stay above this level? And it's really hard to read that. It's about at 38.09 or 38.10 roughly. And we're still above that at 38.21. But if we continue to fall and break through this level, that will turn things even more negative. Longer term, we're still below this other double fib level, where we're at 38.21, where we need to get back to 38.30, anywhere from 38.26 to 38.30 to get back what was lost on this chart. And weekly, we're just right about on this level at 38.19. So we're seeing a lot of convergence on our support levels. We're still above this 200-week moving average, but if we really start to fall, we'll want to keep an eye on this level. It held up back here when we hit the October lows. If we continue to come down, will that hold up again this time? If we drop below this and then close below it and then stay below it, that's going to turn things a lot more negative. But so far, it's been holding up. Our trend channel, we're down at the underside of the midpoint of the trend channel currently. And the Dow still above both of the moving averages, the 50 and the 200. As long as we stay above this golden cross will appear to be valid. If we drop down below this, then you'll eventually see these moving averages turn down as well. The Dow came down to S1, and so far that's been holding. Can it hold and go back up from here, or is it going to fall down below that support level? So what's our outlook for Wednesday? The technicals are still negative, and we're still in this oversold condition, even with the slight up day. We have the weekly mortgage applications index coming out, the current account balance for the third quarter, consumer confidence, and then the biggie will probably be the existing home sales, although consumer confidence is pretty important too. We have the whole list of geopolitical events, with the inflation and interest rates being the real focus for the stock market. We have the potential lockdowns and the COVID spreading in China, which may affect some of the growth as far as U.S. companies are concerned. I've also highlighted Japan down here. This has been on our list for quite a while. We've been keeping an eye with what's going on in Japan. We'll have to see if that develops into a more drastic situation. So our scenarios, not really going with the down one, even though we are negative, we're still in that oversold condition and may see some more attempt at a bounce while that oversold condition works off. And then if we do get that bounce, we'll want to evaluate things to see, are they turning more positive? Or like in Tuesday's session, we had an up day, but things are still looking decidedly negative. Can't really go with the up one because we're so negative right now. Our scenarios continue to deteriorate. Our sector rotation, our setups, they're still looking a lot weaker right now, and they're getting close, but they're not really generating new signals yet. These signals are generated when we get to extreme negative readings, and we still have a ways to go with those charts. We're still battling to see if we can get back above some moving averages, some pivot levels, some fib retracements, and other areas of support and resistance. And so far, that's really not happening, other than the fact that as of Tuesday, we're still staying above the 3,800 level with the S&P 500. So we're going with more of the sideways trend right now because the ADX is still below 20. It's declining. It's below the moving average, and it is negative with the red line on top. So our conclusion, the S&P is negative, and it's becoming more oversold. Tuesday did very little to work that off. Intermediate term, we're negative as well, and with our CCI charts that I talked about, that's really the only oversold condition we're getting currently. Long term, we're still negative as we remain below the 200-day simple moving average. And the longer we stay underneath that, the more damage it does, and the more work will be involved for the S&P to get back to a more positive stance. Thank you. Have a really wonderful Wednesday. This will be the only video that I post, and I'll look to talk to you again in the next video.